is Moss from Investor Partner Group coming in live today in relation to how to pick. I want to buy something and it's not a forever home, then do not.
That brings me to a very, very important question, and that question is on a lot of people's mind. And I myself have asked myself that question a lot of times. What does an ideal portfolio looks like? Could you explain to us?
Yeah. And yeah, 100%. And so naturally, what comes to people's mind is that, you should buy the biggest property size. Biggest land size means the biggest property portfolio, or the number of properties basically for some people resonates that this is the best property portfolio possible, right? And I use this example that just the size of the diamond ring does not guarantee the success of the marriage, right? And so the size of the land does not guarantee the success of the property portfolio. So it's very, very important that, people say size matters, size matters. Hey, you have to think about what matters, especially when you're building your property portfolios. Okay. And so if you think about an ideal property portfolio is really a sustainable property portfolio. A sustainable property portfolio is something that works on its own, is transferable, creates intergenerational wealth, can service itself off, and is well managed. Now, I use these words very carefully that it has to be well managed because a lot of people mismanage their portfolios as well. And you mismanage anything and you can potentially lose it, right? You mismanage your life and you would be at the verge of divorce. You mismanage your business and you would be looking at bankruptcy. And so you mismanage your property portfolio and you're looking at a poor retirement, right? Or living hand to mouth, right? So you need to think about these things when you're building sustainable property portfolios. If I take a step further into this and explain this in a bit more detail, a sustainable property portfolio naturally means that it is something that is able to generate its own income to pay off its own debt. It generates growth over multiple years and is set up in such a way that it can absorb market shocks like higher interest rate rise, higher inflation, job loss, macroeconomic conditions, a bloody war, and so it does not require a real person to provide cash flow or serviceability to basically protect these portfolios as these sustainable property portfolios. Now, banks love these sustainable property portfolios, which means that every time a banks look at a portfolio which has a healthy LVR, has a lot of cash flow into it, they'll lend more money against it. Okay, so they're not lending money against you, they're lending money against the portfolio itself. And so you need a strong portfolio strategy to create a sustainable property portfolio. It does not happen automatically. People just think that, oh, I'm going to keep buying the properties and naturally, one day it's going to be a sustainable property portfolio. No, not really, not necessarily. Yes, might be a fluke and you might end up there, but majority of the times, you never get to that piece. I look at the strategy for sustainable property portfolios as a voice. It's a powerful tool. It can shine a light on something that has been hiding in the dark. It can change the way people think and it can change the way people act. And so similarly, a property strategy is a very powerful tool. It can place you on the map. It can change the way people think about it. It can change the way people think about money. It can change the way people spend money. But it's not going to do anything if you don't bloody set it up. Okay, so you need that strategy, set it up front in order to basically drive a sustainable property portfolio.
So, Moss, I guess all of these things are literally music to my ears, and I think these are all logical things, and in an ideal world. But I guess we would like to know, how do you build this ideal portfolio?
Yeah. And look, I mean, ultimately, when you're thinking about buying an investment property or setting up these strategies or setting up a sustainable property portfolio, it's a process. It's not an event. A lot of people think about it as an event. They think that it happens once or twice in life. It happens by surprise, like getting your girlfriend pregnant, for example. Okay. So it's not an event. It's a process. It's a method. You need to take right steps. You need to do right things in order. You need to ask the right sequence of questions and you need to get those answers in the right order to make the right decisions before you even start looking at locations or before you even start looking at what properties are going to boom. The purchase of the property itself comes at the very end and it's a byproduct of the process itself. And so let's talk about the process in itself. Okay, so I call this the Yeager method, or the Yeager formula or the few method. There is various different names that I've given to it. And it's basically comprised of three things. It's yield, growth, and return. And naturally, when people think about these three things, a lot of people know what yield is. Yield is an annualized rent divided by the purchase price of the property. Growth is what you're going to get from the property itself as you buy and hold. Or that's what the market is going to deliver to you if you're buying it into the right product, if you're buying the right product in the right market. But return is a lot of that people miss out on. And return is something that you control. Return is something that you deliver at your own peril, whether it be through manufactured equity, whether it be through conversions. There are various ways that you can deliver returns. And so when you're building these sustainable property portfolios, you're using the mix of these three things in various different forms. And so what I do is I classify this as a property investment life cycle into three stages. The three stages are first-time investor, an experienced investor, and naturally a high net worth investor who is either going towards their retirement or already retired. And retirement doesn't mean that it has to be at 60 or 70, by the way, right? Retirement can happen at 30 or 40. It just depends on how quickly do you achieve the goals. And so if you take a step back and you try to understand what does a first-time investor needs, out of these three things, the ingredients of yield, growth, and return, the first-time investor should always be chasing growth and yield. They should maintain their lifestyle, but create a lot of buffers in order to absorb shocks. I call this the foundation of a property strategy. Okay. Once you have done that foundational buying, what you can now do is you can still keep chasing growth. You can still manage the yields, but what you need to now introduce in your portfolio is the return. And the return is something where you're increasing your risk appetite to chase manufactured growth. So you don't want to depend on the market to deliver the growth to you anymore. Okay, you're not playing this gambling game anymore. You want to deliver the returns at your own peril. But you are managing it in such a way that you're maintaining the lifestyle, you still have a buffer, you still have cash flow coming through your properties. The third and the most important thing that people don't really think about is, as a high net worth investor, all you care about is cash on cash returns. You don't really care about growth. You don't really care about yield. Of course, yield is important. I shouldn't say this, that you don't care about yield. And growth is just an icing on the cake for them. Majority of the times, a high net worth investor is living a retired life or going towards the retirement anyway. And again, caveating it back, that retirement doesn't mean that you're ready to die. Retirement means that you are in the phase of life where you're financially independent. And so naturally for these people, it's all about return on equity and improving lifestyle. So it's not so much about waiting on the market to deliver growth to you. It's more about delivering consistent cash on cash returns on an ongoing basis. So for them, it's yield and it's returns. Those are the two things that matters the most, and nothing else really matters. And that's how you build an ideal portfolio.